So today we're going to talk about a different approach to dealing with uncertainty. As you recall, in the first lecture, we dealt with situations of making decisions where there wasn't any uncertainty. And it was just a question of which job to accept with what salary and what vacation, but there was no uncertainty about the consequences. The second lecture, we dealt with uncertainty relative to money and developed utility theory and models for representing people's attitude towards risk. The third lecture, we looked at multi-attribute utility theory, where there was usually money and something else, like the benefits of spending the money or investing the money. And there were also multiple stakeholders, more than one decision maker. This lecture is going to be concerned with how we can hedge uncertainties. In other words, not have to absorb all of the uncertainty of a project at once, but stage it in different stages that would allow us to hedge the possibility that things don't work out the way we hoped. So we're going to first talk about investment decision making. And by that I mean not individual investments, but investments by companies. And the two classic problems they have is how much to invest in improving how well they do now in what they're offering now versus investing money in R&D so they can have new offerings and new revenue streams and profit streams. We'll look at the basic decision problem they face, what they're uncertain about in making these decisions, and we'll take two case studies and then look at these as real options. What if we think about them as buying options in alternative futures as opposed to making the total commitment up front? We'll then review 14 case studies of investments that I've been involved with that were made using these methods. So, investment decision making from a company's point of view, to achieve enterprise objectives in terms of revenue, profit, etc., we have to either increase the efficiency of existing processes or launch new solutions which require new processes and new technologies. So the choice is either to get really good at what you're doing now or do some new things. Now eventually you need to do new things. You can't continue to refine the thing you've always been doing. Some industries might allow that, like a restaurant, but certainly not a technology industry. You've got to be able to do new things. The economic value of potential cash flows associated with either of these should inform the decisions regarding appropriate levels of investments. So the returns you can potentially get from either of these investments ought to inform how much you're willing to invest in pursuing these two paths. And the series of initiatives needed to yield these cash flow streams can determine the processes and technologies needed and the cost of providing them. So that's the overall problem we're looking at. How does a company decide between these two major investments or a mix of the two? So the decision problem basically deals with three time series. There's the time series of investments, how much you have to invest each year. There's the operating costs of providing your offerings, and then there's the profits or profit margins associated with those offerings. And so we have these three time series that we want to use to make an investment decision. There's a lot of uncertainty associated with these three time series. One is market uncertainty. How big will the market be for what we're selling? Will we continue to enjoy the market position we have? Can we achieve a higher or greater market share? There's technical uncertainties. If we're doing new things, will they succeed? If we're doing improvements, will we actually get the returns we expect? Because of these uncertainties, we're going to consider the possibility of multi-stage investments. In other words, starting with a small investment, seeing whether things are likely to pay off, seeing if the market is actually evolving the way you expected, and then using that result as a basis for making a further incremental investment. The basic problem we have is, given these time series, is the investment worth the return? Or alternatively, what is the investment worth? So we're really looking at comparing the value of alternative investments in the company's future. So what are we uncertain about? Well, certainly when we look at different kinds of models, there might be a sigma or a sigma square that portrays the variance of something and portrays our uncertainty. Okay, but uncertainty is actually much more complicated than that. We have uncertainty about the environment. What's the economic situation going to be? The market. What will customers want to buy? What will they be able to buy? How are their preferences going to shift over time? The competition. Who are the competitors? What are they going to offer? What's their intent? Within our own organization, our ability to hand over the new product to marketing and sales. Communications, getting buy-in in general from everyone in terms of what we're trying. Technical, will it perform as we expect? Will we be able to actually have the capabilities we need to deliver? Inputs, what about material prices, labor prices? The overall portfolio, our different investments may be conflicting with each other, both in terms of resources, market considerations, and maybe technical interactions between different offerings. So there's an enormous amount of things we're uncertain about in making these investments in our companies, either to improve what we're doing already or to try to do new things and create new offerings. So here's an example that we worked on trying to look at how we should invest in improving ships in terms of military ships. In this particular case was the example. Now, what are we uncertain about in terms of improving ships? Well, one is the customers. Does Congress have the intent to buy? So will they agree to authorize the purchase of a ship? Second problem, will they appropriate money? They might agree to authorize it but not appropriate money to purchase it. Who will win the award? So here's the customer side. Then the ship technology side, is the R&D successful? Is it affordable? When it's deployed, does it perform as it did in the lab? All those uncertainties come together in the ship production process. We have time uncertainties as well as success probabilities, and we have volatility of timing, suppliers' prices, labor prices, etc. And it leads to some probability distribution of net value. So the concern of the decision maker in this case would be not only with the mean of this distribution, but with the variance. How much uncertainty do I have? So let's look at these two case studies we've talked about a little more formally. One is in investing in the efficiency of the processes for delivering current market offerings. And we're going to talk about returns, costs, and uncertainties in just a minute. The other is investing in R&D to create and deploy new market offerings. And we'll talk about the same three aspects of that investment. So the efficiency case study, what are we seeking? Well, we'd like to reduce variable costs and fixed costs if possible, but sometimes we increase fixed costs to decrease variable costs. For example, we might invest in automation. The cost incurred will be increased engineering costs to create the efficiencies we're seeking, and the capital costs for any equipment, facilities, etc. needed. Okay. The uncertainties and risks. One is sustained prices. We're selling a certain amount of product now at a certain price. Will we be able to sustain that? There is a risk of commoditization, and as is well known in economics, once a product becomes a commodity, the profit margins asymptotically approach zero because all the different suppliers are trying to increase their market share by cutting their prices. There's also a question of sustained demand. Never mind the price, how about the units sold? And then finally, what is the competition doing? What are their strategies? Are they investing in efficiency, or are they investing in new products, for example? So that's our efficiency case study. The R&D case study, what we're trying to do is we're trying to create new offerings over time and new revenue streams and profits because of that. The costs now are both the R&D costs and engineering and capital costs. So we have to invest in creating these new technologies, which may be for products or for services. The uncertainties are the R&D costs and their success. What does it actually cost to execute this R&D, and does the R&D produce a successful result? The demand for the new offerings, we could potentially come up with a new offering nobody wants, or by the time we come out with it, the competition strategies may have come out with something even better, and so we're not in a position to actually make new revenue, new profits because of the competition or because of the R&D failure. So there's a lot of uncertainty in this arena. So here's our pro forma financials. In the first year, or maybe multiple years, we have labor costs and capital costs for R&D. We have in year 2 or 3 labor costs and capacity costs to deploy what we've done, and then we have our operating costs with the revenues, costs, and free cash flows. Note that the R&D is seldom scalable. What I mean by that is that once you've done the R&D, if you determine later the market isn't very large, you can't undo the R&D. Capital costs, deployment costs, may be scalable. Once you find out the market is smaller than you expected, you could scale back capacity, or if it's larger than expected, you could add to capacity. Okay? And then operating revenues usually are scalable. In other words, if the product isn't selling, you cut back on staff, you sell off machines, or whatever. Or on the other hand, if the market is actually bigger than you expected, you can add capacity. So discounted cash flow. I'm hoping for this, some of you seeing this lecture, it's a review. It's all about the time value of money and the notion of discount rates and net present value and internal rate of return. So let's review that quickly. The time value of money is the value of money assuming a given amount of interest earned over a particular period of time. So for example, $100 now should equal $105 a year from now, assuming a 5% interest rate. So a given amount of money in the future is worth less than the same amount of money now. So $100 a year from now is not worth $100 to you now because of the year delay. Future earnings can be discounted by an interest rate that reflect the savings that you've foregone by delaying the receipt of those cash flows, or it could be reflecting the interest you have to pay to borrow the money until you get the money that's yours. The interest rate or discount rate is also used as other means. In discounted cash flow, often people will up the discount rate because they're uncertain about the future. So venture capitalists in particular, they see many, many business plans that predict small loss this year, break even next year, small win revenue after that, and in year 4 it takes off, the typical hockey stick projections. They don't believe that hockey stick, and so they up the discount rate to 25% or whatever, or higher even, and that discounts that outrageous prediction in the out years. So our basic nomenclature, we have costs over n time periods, returns over n time periods. Now the costs and the returns we're portraying here as being particular points, point values, 100 million, 200 million, whatever. Actually, these typically things are probability distributions, and it would be better if we could deal with probability distributions. And we'll talk more about that in a few minutes. So the net present value is a standard calculation here. It reflects the amount one should be willing to pay now for benefits received in the future. And these future benefits are discounted by the interest paid now to wait to receive these benefits later. Internal rate of return is the discount rate such that the net present value is 0. So if you're comparing a bunch of different alternatives, you can force the net present value to be 0 and then look at the alternative discount rates for these different investments, and that's called an internal rate of return. Of course, this assumes that interest rate is fixed and that you can actually reinvest intermediate returns and continue to make it at that rate. That's sometimes a questionable assumption, but nevertheless is quite common in use. So here's our R&D investment. We're going to spend $100 million in year 1, $100 million in year 2. Once we have the technology developed, we're going to spend $500 million in 3 and $500 million in 3, 4. We're going to build a factory, put in the machines, get everything working. And then in year 5, we're going to have a new product in the market with new revenues, operating costs, and free cash flows. And if we do the net present value and internal rate of return at a 10% interest rate, we get $435 million as our net present value. That seems pretty good. But you're going to see in a few minutes why that is almost $300 million too low because of the way the investment is staged, or actually because of the way it's not staged. Right now it's assumed it's all in one stage, but the interesting thing, net present value assumes that I invest this $200 million in doing R&D. At the end of R&D, it fails. The technology doesn't work. But the net present value calculation is such that it assumes even though it didn't work, I went ahead and built the factory. Okay? And even though I have a factory for something that doesn't work, I went ahead and put it in the market. Okay? It doesn't deal with the fact that if the technology didn't work after year 1, probably, I would exit this investment. And so we're going to talk about how to deal with that in a few minutes. So the sources of uncertainty are not explicitly addressed in net present value. The discount rate is often used to compensate for this, but that's not appropriate. It's still done. Okay? The multi-stage nature of the decisions is not considered. The value for hedging downside risks is not assessed. Okay? There's huge value that I can exit an investment after a period of time because it's not working out. And net present value and correspondingly internal rate of return does not address that possibility. Which leads us to real options. Now, real options are opposed to financial options. Financial options would be, for example, a call option on Apple stock, 1,000 shares of Apple stock at $400 a year from now. That's a financial option. A real option would be technology creating an option, a capacity, manufacturing capacity creating an option. It could be a building or something like that. It's real, it's tangible. That's why they call it real options. We're going to talk about the nature of this and then the famous Black-Scholes equations. Myron Scholes and Thomas Merton received the Nobel Prize in Economics in 1997 for this work. Black did not. Fisher Black did not. He died earlier, and they do not get the Nobel Prize posthumously. But we'll show you what earned them the Nobel Prize, and then we're going to talk about how this can be applied to different examples. So an option. One way to think about an option is I purchase an option by R&D costs. So I create a technology that I can potentially put in the marketplace. Then I have to decide whether I actually want to put that technology into my platform that I'm selling my offerings. So working with 3M, they invested for the distributed energy market. They invested in 3 technologies, knowing only one of them would make it to the market, but they wanted to have the option for any one of the 3 because they weren't sure which one would be the competitive technology at the time. So we use these methods to assess the value of those options to make sure that it exceeded the $20 million a year that they were paying to get those options. Another choice is we do research, we earn a technology option, then we decide whether to fully develop it and make it industrial strength, and then we decide whether we want to deploy it in our automobile or our cell phone or whatever. So you can have multiple stage options. We're going to mainly focus on 2-stage options right now, but there can be many more than just 2 stages. So we're going to talk about the fundamental logic of options, the value of hedging downside risks. Let's think about this. Let's say the return on an investment was normally distributed, and some of that normal distribution was negative. In other words, you could lose money from that investment. What if we could cut off the negative tail of that normal distribution? And the way we would do this is we would buy an option such that if it looks like the negative tail is going to emerge, we exit the investment. Now what does that mean? It means that all of the distribution is now positive. More technically, it means that the normal distribution is now log normal. Okay? And that changes our whole perspective on what an investment is worth. We're going to focus not on financial options, but real options, as I said earlier. A call option is the right, but not the obligation to buy something for a fixed amount of money. And a put option is the right to sell. And again, we're focusing on real options, which are, in this case, mostly technologies, but also capacities, factories. And in one example, I'll show actually acquiring a company as a real option. So here's the fundamental logic. Technology and process investments create opportunities for later solution investments. There are options for making a much bigger investment and putting in the market. Okay, so you've bought an option that gives you the right to enter the market, but not the requirement. That's crucial. Okay. There's usually significant uncertainty regarding likely cash flows from later investments. So our projection of 400 million, 500 million, 600 million, those are really the means of distributions. The idea that if someone asks you, and I've had this happen, where a CFO would say, well, you're projecting $400 million as the return in year N, what's the probability that we'll get that return? And my answer always has been 0. The probability of achieving one exact number in a probability distribution is 0. Now the probability of a range, of course, is non-zero. But the point is there is a range, there is volatility, and that makes a difference. Delaying investment decisions rather than deciding now can be of substantial value. Purchasing options gives you the right to act in the future, but not the requirement. So the value of options increases with projected cash flows, which is what you'd expect. The more valuable that future is, the more the option is worth. It increases with time. The more you can delay having to make the full commitment, the better off you are. And it increases with uncertainty. Now why would it increase with uncertainty? Because typically we're trying to reduce uncertainty and we would prefer investments that have less uncertainty. Well, the answer is pretty straightforward. Remember I talked about the probability distribution that might be normal for an investment, and there's a certain portion of that normal distribution that's negative, and which means you'd lose money. What if you can cut off that distribution portion where you lose money by buying an option, and what the option is allowing you to do is to exit if it appears that that negative side is going to occur. Okay? What you've done by cutting out the negative side is you've turned the normal distribution into a log normal distribution, as I mentioned. Now, because it's all upside, the greater the uncertainty in that log normal distribution, the greater the spread, the higher probability that your upside is greater. Okay, so the chance of you being in the money is much greater. In the money meaning that the option is worth it. So, let's talk about the famous Black-Scholes equation. We have a differential equation that relates to the price of an underlying security. Z is a process here with standard Brownian motion, which is usually assumed in the stock market. Sigma is the volatility. And basically you see this first order differential equation driven by white noise. And then we have a first order equation here with no uncertainty. It's with a bond. And the bond is part of this portfolio that you buy so that when it matures, you have the money to exercise the portfolio. So one of the innovations of Black and Scholes is to look at this as a portfolio of a bond and an uncertain security. Okay? And they basically say a security that is derivative to S, the underlying security, which means its price is a function of S and time, given by FST, can be found by solving the Black-Scholes equation, this partial differential equation. So this is in part why they get the Nobel Prize, for coming up with this equation that shows you how to solve this problem. Then they solved it for the European call option. A European call option is a call option that can only be exercised on the date of maturity. And here we see the solution. It's just a bunch of algebra. These are normal distribution points that you actually look at from a lookup table. And you can calculate these again with just this algebra. And so now we know how to calculate the value of an option. So let's revisit our example from before, the technology investment example. We're going to look at an option over 2 years with 90% variability around these point estimates. So that's quite volatile. A risk-free rate of 5%, which is what the bond earns, and a discount rate of 10%. We invest $200 million as before, which has a net present value of $174 million. We then invest $1 billion to deploy it, and this is our free cash flow from our earlier spreadsheet. And the option value is $867 million, and if we figure the net option value by subtracting the cost of buying it, it's $694 million. So there's a bit under a $300 million difference between the NPV and the NOV. Okay, now why is that? The reason is the substantial value in being able to exit this investment if it's not paying off. In other words, this investment goes $200 million, and if it's not working out, you stop and you walk away. So what you've done is you've hedged the downside risk. The most you can lose is $200 million. Where actually, if you proceed with the whole thing with a lousy technology, which what turns out to be a bad idea, you can lose a lot more money in this. So this is a Black-Scholes calculator we created in Excel. We used to sell a product that did this. Motorola was our lead customer. We had a very fancy tool, lots of interesting graphics. The vice president who was my customer for that came back to me recently, a couple of years ago, and said, can you redo this tool for us? Because we still like to use it, but it's a little out of date. My having left that business about 10 years ago. And I said, well, I don't want to reprogram it, but let's see what we can do in Excel. And we did it over in Excel and sold it to them. We also did a Monte Carlo version so that we can actually put probability distributions around all of the different parameters here. So not just the volatility, which handles the uncertainty, but we can have uncertainty in several other things as well. So option value in words. The value of an option equals the discounted expected value of an asset at maturity. We talked about that. Condition on this value exceeding the cost of obtaining it, the exercise price, minus the discounted price, so we're just looking at the gain, all times the probability that at maturity the asset value is greater than the option price, otherwise you wouldn't exercise it. Okay. Net option value equals the option value in the calculated in this manner minus the option purchase price. So this is from a book by Smithson that is real down to earth in terms of how it explains these mathematics. Now, how do we use net option value? Peter Boyer has written a couple of very interesting books. on option pricing models and how to use them in technology businesses to make decisions. And he argues for combining net option value into strategic value. And what he says is strategic value is the net present value of what you can earn doing what you're doing already, plus the net option value of what you can do if you exercise the options later. Okay? So he's actually talking about the value of the company you have versus the value of the company you might become. So a few years ago, I did a variety of engagements with Raytheon and their chief financial officer looking at the value of 6 different Raytheon companies in terms of the technology they had that could go into different markets. And after I finished the first one, which was a wireless LAN company, which was a very small company, and the question was whether it was worth retaining this company in this $20 billion large corporation. And so they had me look at both the business they were in and the business they could be in. I worked with their management team. And interestingly, the day when I got to make my presentation of the evaluation of the first company, I go to the headquarters. I'm about to go into the CFO's office, and the vice president, who was my day-to-day contact, said, "Oh, by the way, there's one thing I need to mention. Frank says Frank only allows you to make a presentation with 1 slide." So I had to quickly look through my nice slide set and pick out 1 slide. And I picked out one, and it had a bar graph on it. And one bar graph was 3 million high, and one was 300 million high. 3 million being the net present value of the wireless LAN business they were in for commercial applications, and 300 million being the net option value for the consumer LAN business they could be in if it emerged in the next 2 or 3 years. So I went into the CFO's office, I put the chart on his desk, and in typical fashion, for those of you who've interacted with chief financial officers, he said, "What does it take to get the big bar?" So he wanted the 300 million. And I basically said, you need to stay in the business, realize it's very modest returns, and in 3 years you need to decide if you're willing to invest another 10 million to get the 300 million. And as a consequence, they stayed in that business. So this is a good example where the business that they had was modestly valuable. The business they potentially could have was extremely valuable. And this is the whole notion of option-based thinking. Our efficiency investment is back here again. We invest 600 million to become more efficient and increase our profits. Notice here, this is just a net present value, net and net option value. It doesn't make sense to do net option value for an investment for all the commitment that comes up front. There's no option you're buying, you're just doing it or not. Okay, so if you actually were to force it into a net option value formulation, what you'd find is the net option value would be basically the same as a net present value. There'd be no value in going through all the detailed analysis. Now let's look at our comparison of metrics. So the efficiency case study is 55 million. The NOV is not 0. This should just say not applicable here. The R&D case study NPV is 435. The NOV is $260 million higher because of the staging of the investment, and the strategic value is the sum of the two. In this case, if the company had the money to invest, it would be well worthwhile to pursue both the efficiency and the R&D case study. They may not have the resources to do that. The key point here is that the net present value very much undervalued the value of an investment where you could stage the decisions, where you could stage the investments. Okay, in general, net present value is more conservative than net option value. Now let's look at a bunch of case studies. We've done about 25 case studies. I'm going to show you 14 here. One thing I like about these case studies is that not only do we write our papers on these methods and get them published, which is you want to do as a faculty member, but we actually got companies to make real decisions using our tools, which is very satisfying to an engineer like me. The 4 case studies, many of them involve investing in R&D. Some involve just running the existing business and you're creating option value just by staying in that business. Some involve acquiring capacity, manufacturing capacity, for example. And in one case, it was actually much more reasonable to acquire a competitor rather than to try to create technology to work around their patents. So here's the 14 case studies. They're for Lockheed, Ministry of Defense of Singapore, Raytheon, 3M, Ministry of Defense of Singapore, Raytheon, 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 Motorola, 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 and Raytheon. And these are the only ones that I can show you. You can see many of them were just investing in R&D, and then they would later deploy the results. Some of them were running the business. One was investing in capacity. This project right here for Motorola for MRAM, magnetic random access memory, the net option value is about $500 million. This was the net option value for a requested investment of $20 million. This was such an interesting and compelling case that it made all the way up to the chairman, chief executive officer. He looked at the case and said, this is such a tremendous opportunity. I'm going to give you $40 million. Come back in 2 weeks and tell me how you spend that well to better secure this opportunity. The nice thing for us is after that everybody wanted to use our tools because it was, and in fact it was eventually required. The interesting thing for Motorola is they took this technology to the market. They ended up creating a huge business success. They ended up breaking it off as a separate company, spinning it off, and making many billions of dollars from that. So it's a huge success story. If we look at these all together, the net option value is $4.2 billion. In other words, these people's investments were creating $4.2 billion more than they would have expected had they just looked at this in a traditional manner. Okay, so this is an enormous success in terms of the impact of these tools on decision making, and all of these decisions were decisions that were actually made. So let's review quickly. We looked at investment decision making in terms of either investing and getting better at what you're already doing, or investing and doing new things. And we frame this as a classic decision problem. These problems are full of uncertainties. As you might have seen there, there are like 20 or 30 different kinds of uncertainties that plague these investments. We did 2 case studies, one for efficiency, one for investing in R&D. Real options allowed us to take all those uncertainties and hedge them. Now, what do we mean by hedge them? We were able to have an exit point that allowed us to avoid the full brunt of all the uncertainties, especially as they manifested themselves over time. Then we presented 14 case studies that allow us to see how these things are used in real decision making. Now, the next lecture on behavioral economics is going to focus on the issue of how do people actually make decisions in real life. There are decisions such that what pizza toppings to order, that this is too much mathematical machinery to figure that out. You can just trust your intuition and your preferences. And actually there are a lot of decisions that experts can make with intuition and make as good of or often a better decision than you can with all this analytic machinery. On the other hand, there are cases where the decision is so important, it's so large, it's so uncertain, it's so unusual, and you're so unfamiliar with it that you need to think about more formal methods. And we'll talk next lecture about how to decide when to rely on your intuition, the behavior that you would just naturally exhibit, and when to rely on more formal methods. So until then, thank you.